Let's have a look at a couple of examples of where you might place stops in actual trades. If we have a look at this chart, we can see that it's setting up nicely for a short. We've got a couple of reasons why that is so. You can see it's made a high and then it's failed to make a higher high with the second arrow. And within that we can see we've got a small uptrend forming, which is defined by a low and then a higher low. Now it looks like we've broken down through that second low there. Now if we break through the first low, the wider of those two yellow bars, then we would definitely have broken that uptrend, and in fact we'd be making a classic head and shoulders pattern. As you can see, if we break through, just extend that dotted line out there so you can see what I'm talking about. So as I say, if we break through that, there's a few things that could happen. It could go up, obviously, could go sideways, could go down. If we break through that dotted line, then the probability is that we're going to continue going downwards. So let's see what happens next. We can see that indeed we've broken down through that extended dotted line. So assume we enter a short position. Now if I took an entry here, I would be looking to exit that trade manually, not with a stop but manually, if the trade didn't go immediately in my favour, because this is a very clear short. We've got a couple of reasons to believe that probability is on the short side. So if that didn't work out immediately, I would get out, and I would look to get out with maybe a 2 or 3 cent loss, but certainly no more than 5 cents, because I can take 5 cent losses all day. I only need 1 or 2 good trades to more than make up for those sorts of losses. So as I say, I would exit manually if the trade didn't go my way. But before I do that, I will, of course, as soon as I'm in the trade, enter a stop into the market as my emergency exit. So the question is, where do we put the stop? The answer is anywhere really, because we're not looking for that stop to ever get hit, but we do need to put it in a reasonably sensible place, and a sensible place on this chart looks to be about there. We've got a little bit of resistance going on there. So if we, in the worst case scenario, if the computer blows up, internet connection goes down, phone line goes down, and we've got no way of manually exiting the trade, then we know that if the worst happens, we ain't going to lose any more than that. So we'll have a look at where this chart went next, and you can see that trade's working out nicely, that short's working out. So as soon as we've seen that that's going in the desired direction, we'll move the stop to break even, so that again, if anything goes wrong, we're essentially getting out without losing anything. But we're still looking to manually exit the trade. And as this price fell away, I would keep moving the stop using sensible positions like this little higher here that it made, this lower high. That would be a good place to move the stop to, and so on. Keep moving the stop down, but always giving the trade enough room so that it can wiggle around and that you can make an informed decision and exit manually based on the market conditions and everything else that's going on, not just what you can see on the chart, but everything what's going on off the chart as well. Alright, that was an example using a short trade. Let's have a look at another example, this time going long. You can see here that we're in a downtrend initially, defined by a series of lower highs and higher and lower lows. We've got some clues to possible change of direction about to occur. One of those clues is that these red candles, these down candles, are getting progressively smaller. That's a fairly good sign that we might be in for a change of direction. The downtrend appears to be running out of steam. It's going less far down each time. We can also see we've got a pretty bullish pattern here with those two candles. And if you've done any analysis of candles, then you'll see immediately what I'm talking about there. So anyway, that's a couple of reasons why we think that we might be in for a change of direction. Let's assume that we decide to go long on a break of the previous high, and that's a change of direction. So I've just extended that out there, and that will be our entry. Okay, so going on to the next chart, you can see that this has indeed broken through that high, that dotted line. So we would have gone long here, and now we need to put in a stop as our emergency exit to take us out if we can't get out manually. So the question is again, where are we going to put the stop? It's a little bit less clear on this chart. There are a few different options. We could put it right down the bottom at the lowest part of the chart. If we go any lower than that, then obviously that's not worked out for us. We could go back to the previous low. That looks a bit more reasonable. And if we want to be a bit more cautious, then we could use the high of the previous bar, previous candle before the candle where we took our entry. As I say, it's all down to personal preference. It don't really matter because we don't ever want this stop to get hit. It's only there to take us out in an emergency. So where we place a stop really comes down to personal tolerance for risk, I guess. So last chart, we can see that this trade stormed away. There was our entry. So first thing to do would be to move that stop to break even. Again, if the trade hadn't worked out, I would have looked to get out manually with a tiny loss, a couple of cents, 3 or 4 cents maybe at the most. Because I know I can always go back in again if the trade goes back in my direction. I can take another entry, and we only need for it to go 3 or 4 cents in our favour to cover that previous loss. So, as I say, would have put a stop at break even, and we could move that stop up as the trade worked out, choosing sensible places to put it, like this previous resistance, or which would we would expect to become support. So, using obvious places like previous highs and lows, which will tend to become support and resistance. But for exiting, always looking to get out manually and not waiting for the stop to get hit. So to summarise, stops are not there to exit trades. They are emergency exits to take you out if you can't exit the trade manually. Exiting manually will always give you more flexibility in exiting your trade, and more flexibility means more potential to take more money off the table, make more money out of your trade. So we never want to wait for a stop to get hit, but at the same time we never want to trade without putting a stop, because disasters do happen. Computers blow up, power goes off, internet connections break, and we need to make sure that we're protecting our account, and that's what a stop's for. And again, just a final disclaimer, this is my way of doing things. As I say, I know other people do use stops as exits, perfectly valid. That's their way of trading. This is my way of trading. It's served me well, and I hope that if you follow this advice, that it will serve you equally well. Okay, that's about all I can say on stops. I think we've done stops to death. If you've got other things you want me to cover in videos, do get in touch. There's more videos on the blog there. You can get in touch. Email address is on the blog as well. Let me know what you think of the videos, what you want me to cover, and I'll be more than happy to oblige.